Hello my fellow freedom builders and welcome back to the channel to a quick update about a crazy news week where we really have to be on our toes. Now, I would have made this yesterday, I got a bit delayed, I'm sorry for that, but here we are. We have been used to for a couple of weeks that everything has been controlled by earnings. The S&P 500 is in the middle of the earnings season. And it is kind of interesting just to jump over to that quickly. We have the fact set, they come out every week with a summary of the earnings. And we can now see, this was on Friday, we can see that more than half of the S&P 500 companies have been reporting actual results. 79% of these companies have reported positive earnings per share surprises. Meaning, of course, that they have dumped the estimates, or the analysts have dumped the estimates, so it would be easier for the earnings to surprise. But that also means that a lot of these drops in earnings per share, they are already priced in the market. Nobody knows how much, but at least a great deal of it. We can also see that 74% of the S&P 500 companies have reported positive revenue surprises. So that is interesting. The blended earnings decline for S&P 500 is minus 3.7%. That can sound quite dire, and of course it is. We are in the middle of an earnings recession, if you ask me. But it was actually estimated that we would see a minus 6.7%. So minus 3.7 is actually not that bad at all. Of course, there are some major players. We can, for instance, see that the S&P 500 consumer discretionary earnings growth with and without Amazon. So that is quite a lot that some of the big players are taking up in this space. But that was just to give you a quick update. I made a video about this a couple of weeks ago where only 6% of the companies have been reporting their results. And at that point, the number was actually not even as good as this. It just keeps getting better and better, which makes me to believe that we actually have seen the bottom in the market. Now, I have gotten a lot of comments on my last video saying I thought we had seen a bottom. Many people are convinced we should 10, 20, some say 50% further down. I'm not too sure about that. I think we have seen the bottom. I can't say, of course, that we can't move a bit further down. But taking out the bottom down here would take right now a drop of 17%. And I don't see that in the cards right now. Now, the arrows here are my own cycle indicator. As you can see, it's not completely exact. It is a statistical thing I'm using here with some wave cycle math in there. And it tends to hit the switches from up to down fairly well. And as you can see, we had a downturn statistically here. Then we have some massively good earnings last week that pulled the S&P 500 up a bit. But if we can go sideways here until we start getting some upwards reading, it actually will be an indication that the quote-unquote down wave has formed. That doesn't have to go down, it can just go sideways. So the down wave has formed by going sideways, and then we are ready for a move further up. All right, on to the news for this week, because it's not the earnings I'm mostly concerned about this week. This is actually the economic news. Yesterday, and here I'm using dailyfx.com. I'm going in here on the calendar and economic calendar. You can all do that, it's for free. The 1st of May here, the only thing that really popped out was the ISM manufacturing PMI. That was slightly more positive than expected. That was not a big mover, but it was a little piece to the puzzle here about what Fed will do tomorrow, Wednesday, when they are coming out with their interest rate decision. So until today we actually saw that, let me see if we can have it here. No, it's not on here as far as I can tell, but Australia hiked their interest rate today by 25 basis points. From 3.6 to 3.85, I think it was. But the big thing, of course, today, right now, is just here about half an hour ago, we had the euro area, we had the inflation. The core inflation, that is excluding fuel and food, it actually dropped a bit. It was expected to go just a level from 5.7 to 5.7, but it dropped 0.1. It's not massive, and it won't do anything to the ECB decisions about hiking the interest rate later the week. You can see the normal inflation rate actually popped up a bit by 0.1%, but that was also expected. Now, today at 4 o'clock my time here in Denmark, we have US factory orders. That is also an interesting thing that can tell us a bit about the activity in the factory sector. Then there's a thing here. I'm not sure why they have put that on as a low impact, but that is probably because it is primarily an FX site. But I think it's fairly important. That is the JOLTS job openings. That tells us how many open job positions are in the United States. And if this number is very high, it means that there are a lot of open jobs and a lot of vacancies, meaning that the employers are bidding up the wage level, meaning that we are pulling some more inflation into the system. However, if this number is dropping, and it is forecast to drop by a couple of 100,000, now almost 10 million is still insanely high, but if it is to drop, we can see a less and less pressure upwards on the inflation. Looking at the next 7 days here, we can see there comes some big things in. Wednesday, looking at that, we can see that we have the ADP employment change. That is kind of a precursor to the NFP we are getting on Friday. So that is where they're actually looking at some statistics from the salary payout system. But then we get some service PMI, and of course the big thing here Wednesday is the Fed interest rate decision. And about that, right now it is forecasted to go from 5 to 5.25%. Looking at the FOMC countdown here, you can just search for FOMC countdown if you want to find that. That is tomorrow in 1 day and 8 hours. You can see that the market is right now pricing in almost 100% certainty of a one rate hike, meaning 25 basis points up. That can change quickly, I should say. If we are looking at the probability here now, it's 97.4. 1 day ago it was 93. A week ago it was 75, and then 1 month ago it was only about 50-50. So that can change quickly. And with the numbers I've seen, I know the GDP numbers last week dropped a bit, but there's not much in the numbers that should really get the Fed to not hike. As I've said before, I think it's a big mistake to hike any further. I think we are starting to see, both in the earnings recession and the GDP dropping, I think we are going to see the effect of the rate hikes in the upcoming month. I think Q2 will definitely also be a place to look for results there. But again, Fed, central banks, they are often 1 or 2 or 3 quarters behind. We saw it with the hiking of the interest rates. They were way too slow, as I said at that point. At least 2 or 3 quarters too slow starting to hike. They kept saying it was transitory. So anyway, they will probably hike the interest rate tomorrow, Wednesday. We can also see here, in this chart, we have all the yields, meaning this is not the prices, but the yields of the different US bonds. We can see the inverted yield curve that I've talked about many times, with the shorter term yields on top here. The 1 month yield just dropped down, and that was simply on the scare about the debt ceiling, and all of a sudden the investors were only buying the very short bonds on 1 month because they were too nervous about this debt ceiling thing that is coming. And it is coming, and it can be scary, so we'll probably see some volatility on that. However, we can see that the shorter time frames here are going up. I drew this circle way back here and said that if Fed is going to hike to 5.5%, that is where we're going to see these shorter term time frames. At least 1 and 2 months should go up here somewhere, and that is close to being fulfilled now. But we are seeing the interest rates taking up, and that is all a result of Fed hiking the interest rate tomorrow. It will be very interesting to hear what Powell has to say about their future expectations. My guess is that he will say that they will probably pause, wait and see the long-term effect of interest rate hikes and so on. So he will probably indicate that for now they won't go any further than 5.25. All right. Thursday, we have the ECB interest rate decision. That, as I said, it is a crazy week this week. So they are estimated to hike at 25 basis points. I hope they only hike 25 basis points. They have hiked 50 basis points before, as the Fed has done several times. But let's see what happens there. I would be very surprised if they are not hiking. They are behind the Fed, so they have some catching up to do. Then, lastly, Friday, we are going to see the non-farm payrolls, meaning how many new jobs are created in United States. And if we are looking at the numbers here, there was this, I guess you could say, outlier. That was a big surprise, this one. I'm not sure why it was so big, but we have seen a downward trend here. And I suspect that will continue with the slowing down of the economy. The whole question is not if we're going to get a recession. As I said in my earlier videos, I think we are in the middle of a recession, because if you take the GDP right now going up by 1.1% and then deduct the inflation, meaning that the money is getting 6 or 7% less worth per year, then we actually have a negative real GDP. So it's actually United States are producing less value if you are taking into account that the money is getting worth less and less. So I think, that is my personal opinion. I know it's not the economics view, but my personal opinion is that we are in the middle of a real recession right now. And that means that we at some point will start to move out of it. And I think that will be over the next 2 to 3 quarters. Of course, at some point it will probably start to show in the real GDP or in the normal GDP numbers as well, with a negative GDP, and then the real GDP negative growth will just be even bigger at that point. But we are going to see some non-farm payrolls Friday. That is going to be quite a volatility creator as well. It is expected for the unemployment rate to go up a bit. Now, this unemployment rate, I know it is what is called the U3 unemployment rate. I normally look at the U6. This is a bit of a artificial thing, if you ask me. However, it is estimated to go up slightly, and it is what Fed is looking at. And if we can see some unemployment rates start to rise slowly, then that can slow their hiking speed as well. All right. I think that was about it. Yes, this is what is important this week. If you're trading stocks on a bit of a longer term, this might not affect much of what you're doing. But if you're a short-term swing trader, or if you are a Forex trader, I'm also doing a lot of Forex trading myself. If you are a Forex trader, this is a kind of a minefield this week. Just seeing the Australians hiking the interest rate in Australia by 25 basis points this morning just got the Australian dollar to shoot upwards, and that was kind of unexpected and a very sharp move there. So there's no doubt that all of the unemployment, GDP, interest rates, that is really something that affect the currency. So if you're trading Forex, be very careful. That's all for now. I won't tire you anymore. I'll get back to you shortly, and in the meantime, take care of yourself and your money out there. Bye for now.